History teaches us something surprising. Great economic systems rarely collapse overnight. The Roman economy did not fall in a day, and the global order before World War I looked stable just months before it shattered. In 2026, the global economy may appear calm, but beneath the surface, quiet fractures are beginning to spread. For most of the past 4 decades, the global economy has been built on a powerful belief that globalization would continue to expand and connect the world more closely every year. Countries opened their markets, multinational companies built complex supply chains across continents, and governments believed that economic cooperation would make the world more stable and prosperous. Factories in Asia produced goods for consumers in Europe and North America, energy moved across oceans, and financial capital flowed freely between nations. This system created enormous wealth and lifted millions of people out of poverty. However, the same system that once made the global economy strong is now beginning to show signs of strain. In 2026, globalization is not collapsing dramatically, but it is slowly fragmenting. One of the most important changes taking place is that nations are beginning to prioritize national security over economic efficiency. In the past, companies built supply chains wherever production was cheapest. A product might be designed in one country, manufactured in another, assembled in a third, and sold worldwide. This made goods cheaper and businesses more profitable. But today, governments are increasingly worried about depending too heavily on other countries for critical products. Events over the last few years have shown how vulnerable global supply chains can be. When political tensions rise or conflicts disrupt trade routes, entire industries can suddenly face shortages of essential components. As a result, many countries are trying to bring key industries back within their own borders or move them to trusted allies. This shift is especially visible in industries that are considered strategically important. Technologies such as semiconductors, artificial intelligence systems, advanced batteries, and telecommunications infrastructure are no longer viewed simply as commercial products. They are now seen as vital assets that influence national power and security. Governments are investing heavily to control these technologies and reduce dependence on foreign suppliers. While these efforts may strengthen national security, they also weaken the global economic system that once relied on open trade and shared production networks. Another sign of fragmentation is the increasing formation of economic blocs. Instead of one highly integrated global market, the world economy is gradually dividing into regional alliances. Countries are signing trade agreements with political partners while restricting economic cooperation with rivals. Tariffs, export controls, and technology restrictions are becoming more common tools of policy. These actions may appear small individually, but together they slowly reshape the structure of the global economy. Businesses must now navigate a world where political relationships influence where they can invest, manufacture, and sell their products. This transformation also changes how companies think about risk. In the past, businesses focused mainly on reducing costs and maximizing efficiency. Today, they must also consider geopolitical stability. A factory located in the most efficient location may suddenly become risky if political tensions rise or trade policies change. As a result, companies are restructuring their supply chains, spreading production across multiple regions, or relocating operations to countries seen as politically reliable. While this approach may reduce risk, it also increases costs and reduces the efficiency that globalization once provided. The result is not an immediate collapse of global trade, but a gradual weakening of the system that supported decades of economic growth. Trade continues, markets still function, and goods still move across borders. Yet the underlying philosophy has changed. Instead of building a single, interconnected global economy, nations are quietly preparing for a world where economic relationships are shaped by rivalry as much as cooperation. Over time, this slow fragmentation reduces trust between trading partners and makes the global system more fragile. History suggests that economic systems often change in this quiet and gradual way. They do not suddenly disappear. They evolve as political priorities shift and nations respond to new challenges. The fragmentation of globalization in 2026 reflects a world that is becoming more cautious, more strategic, and less willing to rely on distant partners. While this transformation may bring new forms of regional cooperation, it also marks the end of an era when economic integration seemed unstoppable. The global economy is not breaking loudly, but its foundations are slowly being reshaped in ways that may define international trade and development for decades to come. Another major pressure on the global economy in 2026 is the enormous amount of debt that has accumulated across governments, corporations, and households. Debt itself is not unusual in economic systems. In fact, throughout history, borrowing has often been a powerful tool for growth. Governments borrow to build infrastructure, businesses borrow to invest in expansion, and families borrow to purchase homes or pursue education. When economies are growing quickly, this system works well because rising income makes it easier to repay loans. The problem arises when debt grows faster than the economy that must support it. When that happens, the financial system becomes fragile, and even small disruptions can create serious instability. Over the past several decades, global debt has increased to historically high levels. Governments have borrowed heavily to fund public programs, stimulate economies during recessions, and respond to crises such as financial downturns or global pandemics. At the same time, corporations have taken advantage of low interest rates to borrow money for expansion, stock buybacks, and investments in new technologies. Households in many countries have also accumulated significant debt through mortgages, credit cards, and student loans. Individually, these forms of borrowing may appear manageable, but together they create a massive financial burden that depends on continued economic growth and stable financial conditions. One reason debt has grown so rapidly is the long period of low interest rates that followed major economic crises in the early 21st century. Central banks lowered interest rates to stimulate economic activity, making borrowing cheaper and encouraging spending and investment. While this strategy helped economies recover from recessions, it also encouraged governments and companies to take on even more debt. When borrowing is inexpensive, it is tempting for institutions to postpone difficult decisions about spending and financial discipline. Over time, however, this creates a system that becomes increasingly dependent on easy credit. The challenge emerges when economic growth slows or interest rates begin to rise. In such situations, the cost of servicing debt increases, meaning governments and businesses must devote more of their income to paying interest rather than investing in productive activities. For governments, this can limit the ability to fund social programs, infrastructure projects, or economic development initiatives. For companies, higher debt payments can reduce profitability and discourage investment in innovation. As more resources are directed toward repaying old loans, the economy can gradually lose momentum. History offers many examples of societies struggling under excessive debt. In ancient Rome, repeated financial crises were triggered when wealthy elites and governments became overextended. In later centuries, European powers often borrowed heavily to finance wars and imperial expansion, sometimes leading to fiscal crises that weakened their economies. Even in the modern era, financial crashes have frequently been linked to unsustainable borrowing. The global financial crisis of 2008, for example, was closely connected to excessive household and banking sector debt. In 2026, the situation is not identical to these past crises, but it shares an important similarity. The global economy is heavily dependent on debt to sustain growth. Governments continue to borrow to maintain economic stability and support public spending. Corporations rely on loans and financial markets to fund operations and expansion. Meanwhile, households in many countries depend on credit to maintain their standard of living. As long as economic growth continues and financial systems remain stable, this structure can function. But if growth weakens significantly or financial confidence declines, the burden of debt can quickly become difficult to manage. The danger is not necessarily a sudden collapse, but a gradual constraint on economic vitality. High debt levels limit flexibility, making it harder for governments and institutions to respond effectively to future crises. Instead of investing in long-term solutions, they may focus on short-term strategies to keep the system functioning. Over time, this can create a cycle in which economies rely increasingly on borrowing just to maintain stability. In this sense, rising global debt acts like a silent pressure within the economic system. It does not immediately cause collapse, but it slowly reduces the resilience of the global economy. As financial obligations continue to grow while economic expansion slows, the balance becomes harder to maintain. The world may not experience a dramatic financial breakdown overnight, but the growing weight of debt makes the global economic structure more fragile and more vulnerable to shocks that could reshape the future of international finance. Another important factor placing pressure on the global economy in 2026 is the gradual slowdown in economic growth across many parts of the world. For decades, rapid growth was one of the defining features of the global economic system. Expanding industries, rising populations, and technological progress created a sense that prosperity would continue to increase year after year. Many governments built their policies and financial systems around this assumption of continuous growth. However, in recent years, the pace of economic expansion has begun to slow, and this shift is creating structural challenges for many countries. One of the key reasons behind this slowdown is demographic change. In many advanced and developing economies, population growth is declining, and societies are becoming older. Countries that once had large young workforces are now experiencing falling birth rates and increasing numbers of retirees. A smaller working age population means fewer people producing goods, providing services, and paying taxes. At the same time, aging populations require more spending on healthcare, pensions, and social support systems. This combination creates pressure on government budgets and reduces the overall dynamism of the economy. When populations grow rapidly, economies often expand naturally because there are more workers, more consumers, and greater demand for housing, infrastructure, and services. But when populations stabilize or shrink, growth becomes harder to sustain. Businesses face slower demand, governments collect less tax revenue relative to their obligations, and innovation may slow as societies become more cautious about risk and investment. Many countries in Europe and East Asia are already experiencing these demographic challenges, and similar trends are beginning to appear in other parts of the world. Another reason for slower growth is the changing nature of productivity gains. In earlier decades, technological revolutions dramatically increased economic output. The Industrial Revolution, the spread of electricity, the rise of automobiles, and the digital revolution all transformed productivity and created entirely new industries. These breakthroughs allowed economies to grow rapidly because workers could produce far more value with the help of new technologies. Today, technological innovation continues, but the productivity gains from many modern technologies are more gradual and unevenly distributed. While advancements in fields such as artificial intelligence and automation hold great promise, their benefits often take years to spread across the entire economy. In addition to demographic and technological factors, political and institutional challenges are also contributing to slower growth. Many governments are facing increasing political polarization, which makes it difficult to pass major economic reforms. Policies related to taxation, infrastructure investment, education, and climate change often become subjects of intense political debate. As a result, governments may delay decisions that could improve long-term economic performance. Without consistent and forward-looking policies, economies can struggle to adapt to new challenges and opportunities. Slower growth also affects the ability of countries to manage financial obligations. As discussed earlier, many governments and institutions have accumulated large amounts of debt. These debts are easier to manage when the economy grows quickly because rising incomes and revenues make repayment more manageable. However, when growth slows, it becomes harder to generate the resources needed to support both economic development and financial stability. Governments may face difficult choices between maintaining social programs, investing in future development, and controlling budget deficits. Another important consequence of slow growth is the increasing sense of economic uncertainty among citizens. When economies expand rapidly, people often feel optimistic about their opportunities and future prosperity. Jobs are easier to find, wages tend to rise, and businesses are more willing to invest. But when growth stagnates, economic competition becomes more intense. Workers may worry about job security. Younger generations may find it harder to achieve the same standard of living as their parents, and businesses may hesitate to expand. This environment can weaken confidence in economic institutions and make societies more sensitive to political and economic shocks. The global economy in 2026 is therefore facing a situation where growth continues, but at a slower and more uneven pace than in previous decades. This does not mean that economic progress has stopped entirely, but it does mean that many of the assumptions that once guided economic planning are being challenged. Governments, businesses, and international institutions must now adapt to a world where growth cannot always be taken for granted. In this environment, the global economic system becomes more fragile. When growth slows, the pressures created by debt, geopolitical tensions, and structural inequalities become more difficult to manage. The system still functions and economic activity continues, but the margin for error becomes smaller. What once appeared to be a stable and continuously expanding global economy now faces deeper structural limits that require careful management and long-term adaptation. Another important factor contributing to the quiet strain on the global economy in 2026 is the growing tension between major powers and the gradual loss of trust between nations. For decades, the global economic system depended not only on trade agreements and financial institutions, but also on a shared belief that cooperation was beneficial for everyone involved. Countries traded with one another because they trusted that rules would be respected, markets would remain open, and conflicts would not disrupt the flow of goods and capital. This sense of trust created the foundation for globalization. When nations believed that economic cooperation would bring stability and prosperity, they were willing to build deep economic relationships, even with countries that had different political systems or strategic interests. However, in recent years, this trust has begun to weaken. Geopolitical rivalries between major powers have intensified, and economic relationships are increasingly influenced by strategic competition. Countries are now more cautious about relying heavily on foreign partners for critical industries such as technology, energy, and food supplies. Governments worry that economic dependence could become a vulnerability during political disputes or international conflicts. As a result, economic decisions that were once driven mainly by efficiency and profit are now being shaped by national security concerns. One clear example of this shift can be seen in the growing number of trade restrictions and export controls around the world. Governments are imposing tariffs, limiting technology transfers, and restricting foreign investments in sensitive industries. These policies are often justified as necessary to protect national interests, but they also reduce the openness of global markets. When one country imposes restrictions, others often respond with similar measures, creating a cycle of economic competition. Over time, these actions weaken the cooperative spirit that once defined the global trading system. Another aspect of this changing environment is the increasing use of economic tools as instruments of political power. Sanctions, trade barriers, and financial restrictions are now commonly used to pressure rival states. While such measures may achieve short-term political goals, they also reshape global economic relationships, Countries that are targeted by sanctions or trade restrictions often look for alternative partners and develop parallel financial systems or trade networks. This process gradually divides the global economy into separate spheres of influence, making international cooperation more complicated. Geopolitical tensions also affect the confidence of businesses and investors. Companies that operate internationally depend on stable political relationships to plan long-term investments. When diplomatic conflicts increase or trade policies change suddenly, businesses face greater uncertainty. A company that builds factories or supply chains in another country may worry that political tensions could disrupt production or access to markets. Investors may become cautious about placing capital in regions where political risks appear to be rising. This uncertainty can slow economic activity and discourage the kind of cross-border investment that once fueled global growth. History shows that economic systems are deeply connected to political stability. In periods when nations cooperate and maintain strong diplomatic relationships, trade and investment tend to flourish. However, when political rivalries intensify, economic systems often become fragmented. Before the First World War, for example, global trade was highly integrated, but rising geopolitical tensions eventually disrupted the system. Similarly, during the Cold War, the world economy became divided into separate blocks, aligned with different political alliances. The situation in 2026 is not identical to those earlier periods, but it reflects a similar dynamic in which political competition increasingly influences economic behavior. Countries are forming new alliances, strengthening regional partnerships, and seeking to reduce dependence on rivals. While these strategies may provide greater security for individual nations, they also weaken the interconnected global system that once encouraged cooperation. The loss of trust between nations is therefore not just a diplomatic issue, it is an economic one as well. Trade agreements, financial markets, and global supply chains all depend on a basic level of confidence that partners will honor commitments and maintain stable relationships. When that confidence declines, economic interactions become more cautious and defensive. Nations prioritize self-reliance, businesses seek safer markets, and international institutions struggle to maintain cooperation. In this environment, the global economy does not suddenly collapse, but it becomes less resilient and more unpredictable. The networks of trade and investment that once connected the world begin to loosen as political divisions grow stronger. Over time, the weakening of trust between nations quietly reshapes the structure of the global economy, creating a system that is more fragmented and more vulnerable to future crises.